Hello, what's up, everybody? It's Tabitha. Another wonderful day here at New View Trust. We're so excited to invite our special guest, Joshua Andrews. He is from Paper Profits, and he is a huge value add to people that are looking to invest. So we're super excited to hear him talk. Disclaimer, New View Trust serves as a custodian. We do not provide tax, legal, or investment advice, nor do we sell investments. We custody IRAs, ESAs, HSAs, that are self-directed by the client and hold alternative assets. And what is a self-directed IRA? As always, a self-directed IRA is an IRA in which the IRA owner self-directs all the investment decisions and is able to make their own investment decisions outside of the stock market to diversify their portfolio, save money on the investments they're already making, and go beyond traditional stocks, bonds, and mutual funds. So let's welcome Joshua. So excited to hear from you. How are you today?
I'm good. Thank you for having me. I'm very excited to be here and to talk to your audience and be a value add for them, maybe give them some ideas that they haven't thought of or some things to think about. So I want to thank everybody for watching this, taking time out of your day. Everybody's busy, and so really appreciate that. Today, what we're going to be talking about is about retirement. And we're going to be talking about a specific niche of assets that I have a very deep expertise in, and how those could be a good thing to look at for your retirement. There's obviously pros and cons to every investment, but we're going to talk about those at a very high level today, and I hope you get something from this. So before we get started, a little bit about me, just so you understand my background and kind of what's going on. I run a company called Paper Profits with my partner, Jane Wobbs, who is a CPA. This company has been in business for a little over 5 years, and I've been investing in this specific asset class, which is notes and mortgages on the secondary market as an investor since 2012. So I'm going to share with you some examples here of some loans that we've done and loans that we've purchased, as well as some of the things to look at, but more importantly, how this can actually help round out your self-directed retirement account. Just a short thing about me. I know everybody likes to talk about themselves, so I'm not going to ramble about myself, but I want to give you just a snapshot of kind of a background of how I got started and what I'm about. So I currently live in Austin, Texas. I live here with my wife, and we've been here for about 8 years, a little over 8 years now. So myself personally, just as a person, I enjoy reading, reflecting on life, do a lot of stuff with health. So health is super important to me, as is family. So I spend a lot of time and money on that. And then the outdoors as well. I like hiking and things like that. So I actually began investing and learning about this asset class in 2012. And I started kind of by happenstance. I had a consultant with somebody, basically a guy that was wealthy, and he turned me on to investing in mortgages. And so I read all I could, got up to speed, and then used $19,000 from my self-directed IRA to make my first investment. So I'm very familiar with how that works, the pros and the cons, and the things that you might run into. In 2007, I authored a book called Paper Profits, which is what our business is named after. And I'm going to give you an opportunity, if you go to our website afterwards, after this presentation, you just fill out a form. We'll ship you a copy of the book for free. There's absolutely no advertising or anything like that in it. It is simply promotional material, educational material about this specific niche. So it'll answer a lot of questions that you might have. So right now, we manage a portfolio for investors. We have a bunch of different offerings, and that's really my focus, our focus as a business. I'm currently writing a second book about a little bit more granular detail about how to invest with self-directed IRAs, with mortgages. So kind of tying that in a little clearer. And then just a fun fact about myself, I grew up in North Idaho, and I had a very kind of rural background as far as growing up. Our nearest neighbor was 4 miles away. And so we had to snowmobile those 4 miles to get to the school bus in the wintertime because there was just a ton of snow. So let's talk a little bit about retirement concerns first, because I really believe that in today's day and age, we have a lot of information. We have a lot of things being thrown at us and a lot of opportunities, and we need kind of a filter to be able to sift that out. And what I mean by that is it's very easy to get sidetracked with shiny objects. And I do this myself. I was talking to my partner, somebody had turned us on to something. We're like, oh, we should, go do that. But the problem with that is there's always shiny objects. And so getting really grounded about why we're investing our retirement funds, I think is important, because that gives you a framework of, does this new piece of information or this new investment fit into my overall plan? And that's really important, to not get off track and also to sift through the stuff that may not get you where you want to go. So I want to address those concerns first, and then we'll talk about mortgages and how those address a lot of those concerns. So I talk to investors all the time. That's my job, my business. And really what stands out to all of us as we're investing is we're using retirement funds. And those are not gambling funds. Those are things that we have a specific need for at a date in the future. So they need to be handled prudently. But what do we expect from those? So we really expect either getting close to retirement or at retirement. We want financial stability. We want peace of mind. We want to know that this is not going to be a portfolio that's up 30% and down 40 next year, right? We need stability. And so stable income, having reliable income streams, all of those things are super important as we kind of build out our retirement. And then as we're getting into retirement, I know we always hear people say, well, you're going to be in a lower tax bracket because you're going to be making less money and all of that. But I don't think anyone really wants to live less of a lifestyle. You may have less expense. You might have your house paid off or a number of other things, but you want to maintain a great lifestyle, whatever that is for you. I mean, for everybody, it's different, but we want that. And so having sufficient income to where you're not depleting your principal, to just have sufficient income coming in every month like clockwork is very important, I think, for that plan. Freedom and flexibility. So we all have different interests. Some people have vastly different hobbies, different things. Really what money does for us is it gives us the ability to pursue those interests. It gives us the ability to take care of ourselves, to take care of our health, to take care of our family, to spend time with our family, and to really live life on your terms. Now, you might not go out and you might not need your own jet or a yacht or something outlandish. That's not what we're talking about. We're talking about being able to take the trip, to visit family, to take care of your health, to not have to worry about what groceries cost, all of those things that after you're done working in retirement are something we need to make sure we've planned for. So that's really just freedom. And then some other retirement concerns. I know some folks who are great at their job. They're in a W-2 job right now. They are skilled workers, right? So they're engineers, doctors, things like that. And they make great money. The issue is they're burnt out. They don't want to continue, they don't want to wait till retirement age, so to speak, and they want to retire early. But how do they do that? How do they gather enough money, save enough money, prudently invest that, and then have a predictable income stream where they can quit their job? And then finally, I think one of the most important things is risk management. So when you're investing with your retirement funds, this is money that you need to have there later. It needs to be there. And so as much certainty as you can give yourself, as much security, the better. Now, any kind of investment is not 100%, right? Nothing's foolproof. Everything can have a loss, have an issue. We've seen that numerous times through all types of investment. So I'm not claiming that notes and mortgages are foolproof. What I'm saying in this is I think having that security, the collateral, which we'll talk about, of having that passive income stream, but it's tied to a physical property without the headaches of owning the property, is where that security is at. And we'll discuss how that works. And then some other concerns that I've talked with folks: rising cost of healthcare. Things are getting more expensive. They're going to continue to do that. We don't know how fast. We don't know, what the inflation is going to look like and all of that. But we do know it's very clear that over time, everything is getting more expensive. So how do we plan for that? So those are really a lot of the concerns that I think that we go through as investors, specifically with a very narrow lens of how do I use my retirement funds and diversify into different investments? Are they going to get me those outcomes? Are they going to get me much farther down the road versus other shiny things? So we'll switch gears a little bit and we'll talk a little bit about investing in performing mortgages and how those can provide a stable income with very low risk. Now, there's a lot of different types of mortgages, just like there is all kinds of niches for real estate investing. So when somebody says, oh, I'm a real estate investor, that really doesn't tell you a lot because they could be a developer, a land flipper, a rehabber. They might buy homes at foreclosure auctions. There's all kinds of like sub niches in that. And that's very true for this as well, for note investing. So we have a lot of experience in non-performing loans. So I have purchased hundreds and hundreds of loans over the years that from the get-go, they were not paying. And our job was to get them back on track and produce a profit and income. So I'm very familiar with how that works. Today, what we're talking about and what we're focused on is performing loans. And performing is just like you might have a mortgage on your home. It's just paying as agreed every month. The income's coming in. So the borrower has borrowed money from you or someone else, and they're paying like clockwork. So that's what we're talking about here. So with this, these provide a very stable income stream. So you can think of it almost like an annuity where there's an initial investment that your IRA is making up front, and then you're getting a predictable, stable monthly income. So there's no volatility. It's very easy to chart out future events. So if I do this for 12 months, 2 years, 5 years with this amount of money, here's what I'm going to have. Here's when I can reinvest it. It's much lower risk than a lot of other investments because there's something to take. You're very much like the bank. You are lending money. You're securing it against a property. Could be a residential property where someone lives in it as a home. Could be a commercial property, but there's something there on title that's a legally binding agreement where if there's a stop payment where they actually default, you have something, you have collateral to go through a process to recover your funds. And I'll talk a little bit about that, how frequently that happens. It's actually very rare, but this is where the risk part is mitigated quite a bit when you have something that has a lot of value and you've loaned a little against it. And then like we've discussed, you have passive income. So that helps support a lifestyle that's a little bit more hands-off. Depending on your portfolio size, you still need to monitor things just like you'd check your bank account or anything else for errors or anything not being paid or coming in. But it's very, very minimal compared to if you own the property. If you own the property, you have taxes, insurance. If you have a tenant, you have issues there, repairs. You have a number of other things. Not to say owning property is bad. There's a tremendous amount of advantage there. This is much more passive, but with that property component as security. And then some of the advantages are it is kind of like an inflation hedge. So it's not a full-blown inflation hedge. And what I mean by that is we've loaned a certain amount of money to the borrower. They've given us security, like a deed of trust or mortgage against the property. And typically, not always, there are exceptions, but typically what's happening is you have your payments, the borrower is slowly paying down the principal. And over time, over the years, you have a slow appreciation, maybe 2-3% of the property. So if you hold this loan, the longer you hold it, typically, the better your security gets. And it obviously depends on where you start. So how much equity you have when you start, when you make the initial loan, but typically that's what you see. So it gets better over time as far as security. And then diversification, that's very important in today's day and age. And so diversification really just means that you can put small investments into different loans or mortgages in different areas. So I would not, even though I live in Austin and everything's wonderful, I wouldn't put everything into Austin because something might go wrong. There might be new legislation that comes out where something's unfavorable. And so having something in great areas, in different areas, maybe across the US, is the way to go. And it's very, very easy to do this because you don't have to go visit this property in order to make a loan against it. And then it's very hands-off. These require, once you actually make the investment, the heavy lifting is the due diligence, which I would say is 80% of what the actual action required by an investor is. And that's up front. That's before you buy or originate a loan, which we'll talk about. But after that, there's very little management. There's very little you need to do other than just check your servicing portal and make sure you're getting paid. And then the last thing here is these are very easy to understand. This is not a complex financial waterfall or a security, like if you're going to invest in a stock and you're trying to figure out if something's manipulated or what's going on. This is super easy to understand. This is literally a note and a mortgage and a piece of property and a loan that's been made. So if you have a mortgage on your home and you're making a payment every month, you're probably making that to a servicer so that if you send it off to whatever company name it is, that's not the actual owner. There's somebody behind that, which is an investor like us, who actually owns the asset, the note and mortgage. So it's very easy to understand. You don't need a lot of schooling to wrap your head around this. So what is a note and mortgage? Note and mortgage, they're just two separate pieces of paper, documents. The mortgage is a deed of trust. So in Texas, we call it a deed of trust. That's what it is. Other states call it a mortgage. So there's depends on the state where it's at. So this legally secures a financial claim against the property. So you loan $50,000 or $100,000. This is completed. It's a lien against the property that tells the public, anyone, if they were going to sell the property, refinance, whatever, this individual or this entity, this person's IRA, has a claim against this property for this amount. And so they can't sell it. They can't, a lot of times transfer ownership or anything like that, or put a lien above you in a different position until that's been satisfied, until you've been paid. And then one of the important things is that this all happens at closing or at the time where you lend the funds, right? So there's no gap in when this person's like, oh, well, we're going to record it. It happens simultaneously. So you're protected as the funds are given to them. The note, you can think of that as an IOU. So the note so the borrower executes the two documents, the mortgage, which is a security instrument, and then the note's the IOU. So the note's going to spell out the terms, so how frequently the payments are, what the payment amount is, what the rate is, what any kind of late fees would be, if there are any, and most importantly, when the loan matures. So that just means when it's due, when all the payments should be made and the creditor's satisfied. So that's really important. The note typically is not recorded. So it's not on public record in a lot of cases. It's going to be just the mortgage. I couldn't give you a good answer why. I mean, I would think that they should both be recorded, but they're not. And so they're two separate documents. Basically, when you say note investing or mortgage investing, we're talking about the same thing. So let's talk a little bit about like a couple examples to show you a few just variations on what can be done. So you can buy these inside of your IRA. You can have other people buy and manage them for you. You can do all kinds of things with this. So this is a loan that I purchased a number of years ago. And you can see it's a small property. It's nothing exciting. But there's a few things about this that I like. And one of the things is, you can see in the picture, the lawn is perfectly mowed. There's a flag out front. The house, for the most part, is very well kept on the exterior. And they have a travel trailer or a camper. And in general, it just looks like this family really cares about their property. The only thing missing is kind of like a little white picket fence or something like that. So to me, that says this is someone who doesn't want to lose their home. they're not necessarily a sloppy person, and they're interested in their house. And that's very important when you're lending against residential property. You want someone who wants to keep their home, right? Has a pride of ownership. So the fair market value on this property at the time of purchase was $117,000. So it's not very much. I think this is in the Midwest, so there's really not a whole lot of super expensive homes in this area. Excuse me. The mortgage position is senior. So mortgages can have different positions. So you have senior and then junior position loans. And what determines the height, I guess, of those is which one was recorded first. So the first one that's recorded on title takes a first position. The second one would be second, and so forth. And the unpaid balance at the time of purchase was $82,000 and some change. So that's what the borrower owed. Someone else had actually originated this loan, created it, and held it for a number of years and then sold it. And so I happened to be the buyer, and we negotiated a couple things. The payment, $523.47, and the payments remaining $353. And you can see that's almost a 30-year loan. So the question is, why is it that way? And what had actually happened with this loan was the originator, the person who loaned the money, loaned the money, had it for a number of years, and then something happened where the borrower actually stopped paying or needed to modify the loan for some reason. Maybe they lost their job or something like that. Well, with that, they rewrote basically the terms and kind of reset the terms. So I came in just after that, and they had a pay history for a number of months, so that they had paid for a little while. They put a nice down payment, and I said, okay, I'll buy that. So the purchase price for this, it's a performing loan. I paid $40,750 for it. And so that's almost a 50% discount for what the unpaid balance is, right? So for $40,750, I purchased $82,000 worth of secured debt, a first position lien. And there's a calculation that you can do. We use some software called T-value or time value. And it basically tells you if you pay this much for this much debt, and there's some other terms in there, what will you actually get as far as a return, or an annualized yield is what we call it. So for this, we're just over 15%. We're 15.346. And this seemed like a great deal to me because it's a senior position, but not just that. I have it at such a discount that I could almost just keep this for a number of years, collect payments in my IRA, and then sell it. And I could sell that for much closer to the actual unpaid balance, maybe 75% worth of it. So it's something where if you get in at the right price, it's a very, very good deal, because when you need to get out, let's say I don't want to hold it for the remaining 353 months, we might not want to, then you can sell it. So that's one example of like a residential property. And you can see here, this is from the amortization schedule, which super boring, I get it, but this is where like the magic happens from compounding, and where this actually is very predictable for your IRA. So for this is just showing me $40,750 as an investment, takes into account all of the data, and then shows that they're actually going to have an extra payment or a balloon payment of $25,000 at the end of this term. So that's not super common. In this case, it just happened the way the loan was structured. I don't know if they structured it correctly or what they did, but it doesn't matter to me either way. And you can see here that obviously we're talking 30 years, so I'll probably sell this loan before then. But you can see that the ratio of what you pay with high security versus what this borrower actually ends up paying your IRA, very predictable, and a lot, right? They end up paying quite a lot for your investment over time. And then here's another example, and this is a commercial property. Now with commercial, you're dealing with a little bit different animal. You can buy these. Typically what we do is we originate those. And origination just means that the borrower needs a loan, and then we go out and structure that with them. So we actually give them the money instead of buying a loan that's pre-existing. And so in this case, this is a commercial property or set of commercial properties that's actually an apartment building complex. and the borrower needed some funds to renovate some property. And we said, okay, there was already a senior ahead of us on this. So we looked at this and we said, how do we mitigate our risk? We don't just want to be in junior if we're not getting paid or if we don't have a lot of collateral. And so what we did is the fair market value on this is 11.5 million. The senior mortgage is at 3.3. Let's round up, or I'm sorry, 6.3. You can round it up 6.4 million, right? So that's what the seniors owed and is being paid. It's on time. And then we came in and loaned 1.2 million on this property. And then so we have, with all of that, we have almost $4 million of equity above what we've lent. And how that's calculated is super simple. We just look at the fair market value minus the senior mortgage, minus our mortgage, and any other encumbrances or liens on the property. And so that just gives us the cash value of if we had to step in and take this over and start taking rents or whatever, what's left. So the CLTV, or the combined loan to value, is 65.56%. So that puts us in a really, really good spot. If this borrower were to default, how would we recover our investment? How would we get our money back? How would we make sure that we're not out in the cold? And that's how you do that with these types of properties. What we also did on this property to make it even better is we collateralized against other properties. And what that means is we put a mortgage on this property here for 1.2 million. And then we put a mortgage on one or two of this borrower's other properties that are stabilized and cash flowing. And so what that does as a lender, that allows us to really dial in our security, because if this project doesn't go well, we have two other projects to go basically take if the borrower is not going to cooperate with us. So that's super rare that the borrower is going to let something like that happen. They have a lot of time and money invested in this, but we're always going into it with a worst case scenario in mind. How do we pad this as much as possible? Like a bank would, right? Like a lender is, like the things that they do, like we do, how would we pad this as much as possible to provide security? And you can see this is interest-only payments. We're still getting an annualized yield of 15%. There's no discount because we didn't buy it, we created it. And if we were going to sell it to someone, we would have to give a discount. But these are short. This is a 12-month loan, so it's very short. It's almost like a bridge loan, usually 12 to 24 months. So we're in, out, and then redeploy the funds. So there's a lot of different ways you can do this. You can also do partials, which is a whole nother topic, but I'd be happy to talk with you about. I've done lots of partials, and they're really interesting. That's a whole nother presentation in and of itself. So what are the risks? Like, we're talking about all great stuff. What is the risks? The risks are, the main risk is that the borrower stops paying you. And that's primarily due to death. Obviously, if they're dead, they can't pay us. And job loss, that does happen. Illness, maybe they're terminally ill, or divorce, where they're trying to figure out who's paying what and they're fighting. We always have that security to recover our investment. And what can happen typically is, and we'll talk about kind of the frequency of this happening, but let's say worst case scenario, they stop paying. Well, if they stop paying for 30 days, it's really not that big of a deal. There's not much we can do about it. 30, 60, 90 days, well, now they're closing in on default, right? So you have somebody that's non-paying, and then after they get to about 120 days, that's when you can actually, as a lender, step in and give them what's called a notice of default, which is a legal document. They name it differently in different states, depending on where the property is. But what that does is that just alerts the borrower, hey, you haven't made a payment in 3 months. We are about to exercise our right to go take your property, go through the foreclosure process, and maybe sell it if you're not going to pay us. A lot of times, just that one letter, I think it costs $45 for us to send, does the trick. It's not a big deal. Most people do not wake up in the morning and just decide not to pay their bills. It's something has happened. And so there's a lot you can do to fix this. Foreclosure is a super rare event. It does happen. I know we hear news stories about it and all of that, but I'll show you here in the next slide. It's not an everyday thing, and it's actually very easy to deal with. It basically just stalls your payments. right? So you have to actually go fix this issue. So the current delinquency trend, so if somebody's not paying, they're delinquent. After the 90 to 120 days, they're in default. So if they're in delinquency and then moving towards default, what does that look like nationally over the last year, let's say? Now, one thing I would mention, if you would really like to dig into data, there's a really great service called CoreLogic, and you can just Google it, CoreLogic. They have a lot of really, really good free data sets about the US market, all kinds of things, foreclosure rates, but it's all data driven. So you can go in and look, get away from the noise of maybe the news and say, what does it really look like based on the data that they have pulled? So they have economists over there. It's a really, really great resource. So that's where this comes from. And you can see that we have on the left side, 30 days or more past due, 30 to 59, 60 to 89, and so on. And then 120 days past due, then you can see it goes next to foreclosure. And that is a tiny amount of actual residential property that gets to foreclosure. And even then, it doesn't mean the lender is going to lose. In most cases, the lender recovers their money and or makes money, depending on the deal. So all cards are stacked in favor of the lender. Obviously, you have to be willing to work with the borrower. I mean, if they tell you, hey, this is the deal, you have to make a decision. But it's very rare. It's not like you just get wiped out and your money's gone. And there's a lot of things you can do. Bankruptcy, we've dealt with bankruptcy quite a bit as well. Bankruptcy does not remove your claim as a lender. What it does is it just stalls the process. Bankruptcy Chapter 7 stalls your collection for maybe 6 months. And Chapter 13, which is called a wage earners plan, essentially you have, for them to be successful and have the plan created by the judge, you have to be included as a creditor and they have to be making you payments. So either way, it's just an inconvenience. There's a few things to learn, but you don't get wiped out typically. It's super rare. And if you do, usually that's something that you've made a mistake on in your due diligence up front. And then this is a screenshot from one of our servicers. And I took this, I just want to show you how consistent most of these are. Now there's going to be some payment. There's a column there, the third one to the right, called payment day variance. And that's just usually from the first day to the 15th, the borrower gets paid. They might get paid on a certain date. And so they don't incur a late fee until maybe after the 15th or the 20th. And you can see how steady these are. It's just every month. And most loans are like this. And so this is ideal to say, okay, I'm going to invest a portion of my IRA in this or that. And this is going to provide steady cash flow because you have interest coming in and then you have a return of principal. And the interest, where you want to get ultimately is where your retirement, you're living off of the principal, or I'm sorry, the interest. The principal should just be reinvested into more opportunities, right? So that's really where you want to get. And these types of assets are ideal for that. They're ideal to set that up because they're very steady. And you can see on this one, the borrower's already paid just over $30,000 under the total payment column. 25 of that is interest, right? And then there's a little bit that's going to be leftover principal, about $2,600. So this is what actually supercharges long-term payments in your IRA. And you can compound those as it gets older. So in other words, if you have a lot of these together, you can compound. And once you have enough, you go buy another loan or you invest more, you do things like that. So you can get even a higher rate of return than normal. And then talking about compounding, so this is just an example, but you can see the difference of what time does. And we've all heard of compound interest, but it's really important to understand that if you have a long enough time horizon, if you have a few more years in your retirement, what you should be really thinking of is what portion, maybe not all of it, but what portion of my investment in my self-directed retirement can actually be compounded, right? And then once you get there, you can decide, hey, I want to sell these loans or whatever. That's easy. They are liquid, so you don't have to stay in them for the full 30 years or whatever that term is. You can buy and sell those. And then I'd like to close with kind of my personal why for investing. I think that having a why is really important. At least it is for me. And obviously, we need money to survive, like we talked about. We need money to have a good life. My personal why for investing, this is a picture of my father, and I'm the little dude who's like kind of crouched there by the stream looking off. And this was a picture that my parents took when I was about, I don't know, maybe 8 or 10 years old. And we're by a stream on the property, and my dad's got the cowboy hat on. And when I went to visit my parents, they had a scrapbook, and I was looking through the pictures, and my dad pointed to this picture and he said, "This is one of my favorite pictures of us together." And I thought that was pretty interesting. And so the stream is, of course, is still there, looks a little bit different. So when I left, I stayed there for a few days. When I left, we went back to the stream, which looks different now, and stood there and took another picture. And I told him, I wanted to get kind of like when I was a kid and then now, a present day picture. And what I'm getting at here is what money does for us is it buys us time. It buys us time with loved ones. It buys us the experience of life. It buys us the things that we deserve out of life, the things that will make us comfortable, help our friends and family, charity, whatever is important to you. Money is not an evil thing. It's something that is a tool that gives you something else. So for me, it's not about getting a Ferrari. It's not about getting a Rolex. I don't wear a watch. What it's about for me is spending more time on the things I want to do and the people I want to be with. And so for me, this is a good example of what it's about. And everybody's going to be different, but I encourage you to think about, what is it for you? What is your why? Where do you want to end up with your retirement investing? And filter everything through that lens of, here's what I'm trying to accomplish. Does this opportunity or this shiny object or this thing help me get there closer or farther away? And that's all I have. Yeah, that's the end of my
Joshua, thank
presentation.
you so much for sharing your expertise and your story behind why. I think it's super important. I totally, agree with everything that you said. It's super important to know your why, so um, why you're doing what you're doing and why it's important to stay passionate and to invest and to take control of your financial future and not have to rely on a financial advisor or not, have to rely on a job when you're ultimately ready to retire. I think that's, why we're here. And but yeah, if you guys want to learn more, feel free to reach out to us or reach out to Joshua. We'll be happy to hop on a call with you and discuss further, discuss your goals and dreams, and help you get there. Please scan the QR code if you're looking to set up a meeting with any of us, or I know that Joshua's information will be available for you to reach out to him. And as always, please stay up to date with us on all of our social media accounts. Joshua, thank you so much for your time. We're so lucky to have you on for our webinar today. And Amy, thank you as always.